Welcome, everyone, to this week's special episode, which is a co-production of the Main Street Business Podcast and the Directed IRA Podcast. We have the co-host of that show, yours truly, Matt Sorensen, along with the guy who started it all, really, Mark J. Kohler.
Well, thank you, Mr. Sorensen. And this topic is so important. We have to do a co-production. We had to make sure that this topic was like, it really should be on both podcasts. And
this wasn't Matt and Mark being lazy about doing two different podcasts and trying to get a 2-for-1. That just happens to be a benefit. That just happens to be work.
Ironically, yeah, there's that was not even a thought.
It wasn't even part of it.
I can assure you. So thanks, everybody. Yeah, you might be never even heard of Main Street Business Podcast. That is our separate podcast that's all about small business, Main Street America, side hustle, big business, small business, but entrepreneurs. We love that, saving money, making money, protecting it. If you haven't heard of the Directed IRA Podcast, that is our podcast separately dedicated to investing your retirement account, SEP, simple, covered L, IRAs, 401ks, Roth, all the above, and taking control of your retirement accounts and anything related to that. But today's theme, Matt, someone who's written on this, you're passionate about this.
I'm passionate about it. This is a chapter in my book, baby. Due diligence. How exciting can that be? And I know before you turn off and you're like, wait, what did I just start listening to? A podcast on due diligence? Just, hang in there, okay? Okay, bear with me, okay? We've got a top 10 list. Now, Mark and I did this about 10 years ago, I want to say. I don't know if it's a webinar or a really old podcast or back when Mark had his radio show. I don't know. But we came up with this top 10 list and we really sat down and we're like, okay, what are like the 10 things we wish we could tell clients before they go into an investment? When they're taking some money, whether it's their personal funds or their IRA or whatever, and they're investing into some deal, what do we want them to think about? And we made this top 10 list and, in homage to David Letterman, if you will.
Yes. Now, what happened over those 10 years, sorry that we play off that number a little bit here for a moment, is really the list is expanded and or we've really, after 10 years of helping clients around the country, we've learned so much, seen so much carnage and success, both extremes and a lot of in between. We felt like we've really needed to have another podcast that updates this topic. Now, since then, Matt's written a chapter in a book, and I did a webinar for a group the other day and covered what I thought was the top 10 or 12 or 15 or whatever. So at the end of this show, I can guarantee you there's going to be more than 10. Matt said that he's going to update his most current blog article on this. I'm taking notes and I'm looking down at the list of 10, and I've already got a few thoughts. I just want to give a shout out to Brian, a family relative that I talked with yesterday about this. And I said, dude, you got to listen to this podcast when we're done, because he was debating an investment in a PPM, which we're going to talk about here. And so this is good stuff. It's a good reminder for all of us.
Mm-hmm. Yeah. And of course, we're processing them every day here at Directed IRA. 10 times a day, we're processing some investment into a PPM or other type of investment like this. And it's your job. It's not your IRA custodian. I mean, you can engage a lawyer or other professionals to help you do due diligence, but at the end of the day, it's the investor's responsibility. As we always say, you got to be captain of your own ship, so to speak. You've got to be the one at the end that knows what's going on, even though you may be engaging professionals along the way. All right, now what we want to do is we're going to just run through the top 10 first, give you the roadmap so you kind of know where we're going. Then we're going to go back and go through them and probably elaborate and add in some more. But let me start. You want me to hit a few, Mark? You hit a few? What do you want?
Yeah, and I'd like that when I listen to my podcasts, I'd kind of like to see an overview of where we're headed. Because many of you are like, am I really going to keep this podcast on? I don't want to be held captive till I get the final 10 or 12 or 15, whatever it's going to be. And so I'm going to,
the 10th tip is the best one. That's my favorite, actually. So
which one?
So the 10th one.
Oh, okay. All right.
Yeah.
Okay. Gosh. Okay. I'm going to start writing them down, and then you do your 10, and then I'm going to add a few to it, maybe.
Okay. You know what I'm going to do? I'm going to go backwards.
Oh,
is that bad?
Okay.
I'll go backwards on. Okay. All right.
Okay. All right.
Let's start from the end. All right.
Okay. Keep the end in
Okay.
mind.
Number 10, be comfortable saying no. Number 9, I'm just paraphrasing these. Number 9, seek the opinion of another investor or business owner. Now we're going to elaborate on these and give some examples as we go. Number 8, make sure the lawyer representing you is representing your interests, not the other person's. We'll elaborate on that. 7, if you're pressured that this opportunity will pass if you don't invest, don't invest. 6, investigate the background of the person or persons you're entrusting your money or investment with. 5, if you're investing in a PPM, you should get a lot of documents and paperwork. A little lengthier explanation, but that's suffice for now. 4, if you're loaning money on real estate, demand some type of protection on title on the real estate. There's different ways you can do that. We'll go through the different options you might have. 3, if you're told that you can get a commission for bringing your other friends or family members into this investment, don't invest your money in the first place. 2, if you aren't given adequate documents outlining what's been explained verbally to you with the commitments that were verbally told to you in a sales pitch, don't invest. And number 1, if you don't understand how the business or investment makes the returns being promised, don't invest. All right, that's the top 10 list. Now
Okay,
we'll circle back
I'm
through
gonna add a
these.
few more. What was
Okay.
the last one? 'Cause I was filling in the last one was
Number
no.
1, if you don't
Yeah.
understand how the business or investment makes the returns being promised,
Okay.
don't invest. Basically, if you
I got
don't
it.
understand it, don't invest in it.
Yeah. And you know what's crazy is Matt and I have taught a class on this. We co-taught a class for a group in Phoenix years ago on this, and it took 3 hours to go through this stuff. This is a lot to cover. So we're going to do our best to maybe just kind of highlight a few thoughts on each item. Now, I want to say one too. I'm going to throw out a few. Don't put all your eggs in one basket. If you're going to invest, that's okay, but don't. And we're going to talk more about it. So I won't elaborate. So don't put all your
Okay.
eggs in one basket.
So don't go out and buy GameStop stock, all your entire portfolio. No.
Okay. I'm going to put this one. Know the difference between being a lender, a partner, or an investor. You've got to know that difference. Okay. Watch out. I'm going to put watch out for infinity fraud. Watch out for infinity fraud.
Is that like the car infinity, or is that like the affinity, like an A? I believe it's affinity technically.
Affinity, right? That's right. Affinity, meaning
that's not like I bought a bad infinity car. That's different.
Yeah, and Matt's got a story about that. Yeah, we're talking about affinity, meaning you have a familial relationship or some sort of a relationship with someone other than the actual deal.
Yeah.
I'm going to put another one.
Right.
No, and this goes along with Matt's. If you don't understand the deal, walk away. But I think know the terms, know your terms, and I'm going to give an example with this one. Know your terms and what an accredited investor is. Now, there's more terms than just accredited investor, but that opens the terms. Because when I was meeting with Brian the other day, I said, "Do you know what a PPM is?" He goes, "No." And I go, "Okay, tell me about this deal." It was a PPM. And so you want to be able to know terms that promoters might throw around so that, first of all, you're going to look far more savvy. They're going to be held to a higher standard. And I think you're going to be able to ask better questions. So we're going to talk about that, but know what an accredited investor is. Is that okay, Matt?
Okay. Yeah, love it.
Okay, so I added 1, 2,
4.
3 more. So we might get to 15. I kind of like a round number of 15, but there's 14, right? Okay, so we got to go back to the start. And
all right,
you
let's
say
go
something.
to number 1.
Okay.
Let's go to number 1. We'll start there. If you don't
Yep.
understand how the business or investment makes money, don't invest. This seems pretty basic, right? I can't tell you how many times I get documents from a client that wants to invest in something, and I'm like, what? Like, how does this make money? Like, when do you get money? Like, they have no idea what the plan is of the business. They're just given a document that says pretty much, here's how much you need to invest, and here's where to wire it to. It's like, okay, I mean, I wouldn't send that much money under those types of conditions.
Yep.
So make sure you have a good understanding of what the business is and how to invest. Now, one of the big crazes has been crypto, right? Crypto's been hot. How many of you understand crypto? There's a lot of people that bought it that don't understand it. And there's two different theories on crypto of why people buy it. There's people who buy it as a store of value, like Bitcoin, who see it more like gold and it's a store of value. And there's people who buy it because it's a technologically more savvy way in the future of transacting, which could be other cryptocurrencies, not necessarily Bitcoin. So, but just if you're going to get into crypto or whatever it is and put lots and lots of money in it, like if you want to throw $500 at it or $1,000, whatever, that fits your budget. But if you're going to go all in on an investment, which a lot of private investments have a 50 grand minimum, understand what the heck it is. Okay. Dig deep in it, do some research. That's number one for me.
Okay. And I want to tell a quick story about this one. Maybe I'll be color commentary sometimes. Maybe Matt will tell a story. You try to. Here's the story that goes along with that one with me. And I'll never forget it. And this guy was from Texas. And he was kind of, I don't know, a lot of people I know from Texas are colorful guys or women. They're fun, they're boisterous, they've got a lot of personality. I don't know what it is in Texas, what's in the water down there. But I remember talking with him, and he was like, Mark, and I'm looking at this deal, and and he's telling me about it, and he goes, yeah, I didn't do it. I looked around the room and realized I was the dumb money. And I was like, what are you saying? And let me repeat that. He goes, I looked around the room, and he goes, I realized I was the dumb money. And I said, what are you talking about? And he goes, Mark, he said, it's just like a poker game. There's someone at the table that's getting fleeced. They don't know what they're doing. They shouldn't even be at the poker table. And as soon as you can figure out who it is, the better. Because if you can't figure out who it is, it's probably you. He goes, if I can't figure out who the dumb person is in here throwing their money around, it's probably me. Because there's always someone that's just kind of the dumb money at the table or in the room. I said, all right, I like it. And I thought that was a fun standard to live by. So
yeah, I like it. Okay, let me hit number 2. All right. If you are not given adequate documents outlining what has been explained to you verbally, what's in the sales pitch, why they got your attention in the first place, don't invest. Now, this is a common one we'll see of clients that even well-intended clients, I think, make some mistakes. They'll send the documents for the investment, and this is sent to as a lawyer. I'm talking about me as a lawyer, not a directed IRA. Okay, just be clear. We're self-directing. If you send documents over and say send money for this, we're sending money. Like we're not overlooking you and saying don't do that or no, you should add this. Like that's not their role. But so I'm saying as a lawyer here, I get documents from a client and they say, yeah, I'm investing in this. Here's what I'm getting. Here's why I'm all excited about it. And then I go read the document. It has nothing to do with what they told me they were getting. It doesn't even say the terms. And it's very generic. It's confusing. What the person thought they were getting is not actually in the document. But then clients will say, yeah, but they emailed me and said I would get that. Okay, then put it in the documents. Because I guarantee you ain't getting that. Okay. At the end of the day, from a legal standard, there's something called the parole evidence rule. Okay. And this is not the evidence that you get to put on at your parole hearing when you're trying to get out of prison. This is something different. But there's this rule that's like, hey, and then a contractual deal, what's in the contract is what's in the contract. And that's it. Once you put a final agreement to writing, you're like, I'm investing. Here's the money I'm giving you. Here's the terms I'm agreeing to get back. Everything else outside of that contract, the emails, the prior conversations, is inadmissible. You cannot even use it in your trial to say, well, I was promised I would also get this, or I was also supposed to get that, even if it's an email and it's in writing and it's unmistakable. Okay, so make sure that at the end of the day, the final documents that you're signing off on when you're investing represents what you understand the investment is.
Here's my example. I was talking to someone No, this is good. Maybe I'm going to say
like
the
the
next
style of
one.
examples.
Yeah, and you get to do the example on the next one. But here's
All
the
right.
example I had. I was talking to someone recently, and he was talking about his friend. Now, this is going to go down our affinity fraud concern later. But he was talking to this friend in his neighborhood that's obviously successful, big cars, big house, flashy this, flashy that. And he said, he was telling me about the deal, and he says, normally we go after the big folks, and the big money,
Mm,
but I can find a spot for you.
I'll let
We'll
you
make,
in.
yeah, I'll let you in. And he goes,
Absolutely.
yeah. And then he goes, and he says, now this is what our normal returns are. I mean, we're doing this, we're getting 3 times that and 2 times this and all this. Now, but I just want to give you the bare minimum though. We're going to at least do this. And that's what you'll see in the documents. But let me tell you otherwise. I mean, it's really good.
Yeah.
Okay. You can't, if they're going to give you fluff and all these amazing promises, that better darn well be in the freaking document. And don't you dare rely on it unless it's in the document. And when I was talking to him, I said, well, that's what I said. Well, but at least I can guarantee this. And so I'm going to put that down. That's because he has to put that down. The SEC is making them put that down. That's because they can't put in writing what he's promising you. It was phrased in such a way that it was like, yeah, kind of a wink, wink. Yeah, I got to put this in writing to tell you the good deal. This is really the good stuff over here. And you're like, be wary of that. Whatever they promise better be in writing, or it ain't worth. This is a family show. It ain't worth.
Yeah.
I mean, you can put a little word in there, but
Yeah. Insert your word here. Okay. Love that one.
Now, can I?
Yes.
Can I do one? I'll explain it, and then you give a funny or any sort of example. Okay.
Deal.
Number 3. If they come to you and say, hey, by the way, if you can bring someone else in, I'll get you a commission. I'll get you a kickback. I can get you more percentage. If there's any sort of perk offered to you for bringing someone else to the table, that is illegal. And when I say illegal, I think the SEC would probably call it criminal. And if it got bad enough and enough people were brought in and made promises, you're going to get indicted along with everybody else, because the person that loses their money is going to say, well, so-and-so introduced it to me. And if they go to that person under oath and go, did you get any money for bringing that person in? No, but I got 2 more percent. That's money. But I got a car that he let me have. That's money. So if someone's offering you a commission, you want to walk away right there, because these people are playing in a gray area. So any example or story?
Absolutely. I've seen that one so many times. And when Mark says the SEC, I just want to be clear. We're talking about the Securities and Exchange Commission. This is not the Southeastern Conference. Also a very formidable opponent that you don't want to have to deal with, but we're talking about the SEC. Securities and Exchange Commission. Okay. So here's one that I had. This is an interesting twist on it. This was someone who called up and wanted advice because he was told that if he brought investors into a friend of his deal, someone he met, that he would get 10% of what he brought in. And he wanted to bring in his parents.
Ooh.
Okay. Now, here's my conversation essentially with that client. I first said, it's like, well, are you licensed? Are you a financial advisor? Are you licensed to get paid for bringing in investors to anything? No. He's like, but it's my parents. What's the risk? Like, they're not going to sue me if this goes on. I said, let's take a step back. Let's think what's going on here. Somebody you're going to entrust your parents' monies with is going to illegally pay you a commission for bringing it in. Is that the type of business and person you want to entrust your parents' money with?
Mm-hmm.
I was like, that you just don't want to deal with people. The companies that pay those illegal commissions for bringing in money, you have to be very, very wary of. Now, there are some things called finder fees and things that are some exceptions, but that does not, the finder fee, I just want to be clear on, that exception does not apply on a commission. So a finder fee would be someone who's like a public figure, that's like, hey, I'm just a public figure, and they basically pay you for marketing, but they don't pay you based on money coming in or anything like that. So most of the time what we're getting called on is, hey, if I bring in investors, I get a cut, I get a commission, basically a 10%, 5%, 20%, whatever. So
And a flat
those
fee
are always
is the same
illegal.
problem. Yeah, and a flat fee is the same problem. They can't say,
Exactly.
well, it's not a commission, it's not a percentage, it's $1,000. Same problem.
Yep.
But if you say, but if someone comes to me and says, hey, Mark, will you talk about it on your podcast, and we'll pay you $3,000 flat fee to talk about it? Oh, I'm still nervous, but that would be more finder, that I talked about it.
Yeah. And the fee is not 3,000. I just want to say that's, add a couple zeros onto that, but I'm just teasing. But yeah. So okay, commissions.
Okay. Now I've got a good story for number 5.
Okay.
Which should be lots of documents. So you explain, and then I'll share a story on that one.
All right. Well, we got 4 still. We got the loaning money on real estate. You want me to do that one? I'll explain that.
You were kind of going backwards. We did loans. Oh, no. Loans get security. That's where we're at, right?
Yeah, we're on number 4.
Okay, let me explain that one.
Okay, and I'll give an example. Yep.
Okay, we're going 2, 2, 2. We're going to keep splitting it up. All right. Okay. If you're going to loan someone money, I think the best way to look at it is you're a bank. And when you deal with a bank, do they just shake your hand and say, you're off, go have fun, bring us back money? It is no. Being a bank means they want security. They want teeth in some sort of agreement, and they're going to want collateral. And sometimes it's a security agreement where you get a collateral. Could be a stock in a company. It could be, think of a lien on a car, and it could be a first trust deed or a mortgage on a house. And so you want security. If you're going to loan someone money, the main reason you're doing a loan is so that you do have security. Because if you're just going to give them money, hell, I want to be part of the upside. So a loan means terms. I'm going to get a fixed rate of percentage of return, maybe some points, and I'm going to get paid a certain every time, every month or year or whatever. And there's a ending date of when this note should be paid in full. Well, that doesn't mean you're going to get rich. That's a fixed rate of return. And because you're willing to take a lower level of return, you're going to get in exchange for that security. And what is that security going to be? And I would highly recommend our podcast on notes last week on directed IRA, where we talked about the process and everything that's included with that. But when you're a lender, you should be looking for security. Matt, thoughts or stories, for example?
Yeah, there's a couple on this one. So, I mean, one that I had, this is client came in, loaned someone money. That person had defaulted, and they basically said, all right, I want to sue them and get a judgment against the property I loaned them money on. They did an unsecured loan. Okay. And to them, they thought, well, I know there's this person still owns the property. I didn't want to, their thinking was, I didn't want to go through the hassle of using a title company and having to get it recorded. I don't even know how to do that, but I can get on LegalZoom or the web and like find a promissory note that I can use to loan this person money. And so they basically were lazy. Let's be honest. They were lazy and they were cheap. They didn't want to use a title company.
Okay. So lender, use terms in this. You say lender was cheap.
The lender, the lender was cheap. And let me say this, when you're the lender, when you're playing the bank and you're loaning money, you make the borrower pay for this. Okay. You're going to go to title and close this loan. And this was over $100,000, this loan that this person had made. Go through a title company. The borrower pays for all those costs. Okay. Just that's what the bank makes you do. They make you pay for all that stuff. It protects them, but they make the borrower pay for it. Do the same. So, but he was just basically lazy and cheap, the lender. Now, he was defaulted and he came with this expectation of, well, I can sue the person because they still own the property and I'll go collect against the property because I know he's got some equity in it. So we thought. Well, what do you expect happened? We go check title. How many people have sued this guy? How many construction liens does he have? It was a rehab project. How many other
Oh,
people loaned him money on this that actually recorded their stuff? I mean, it was a wreck. And so the client had no security. He had an unsecured loan to someone's company, actually, too, which is another
oh
point here. Not even to
gosh.
the individual that was basically doing a rehab deal. So you want to be careful. What I like to tell clients on this is think about kind of like WWJD, what would Jesus do? Be like WWBD. What would the bank do? Okay. Think like the bank. Okay. The bank's going to like do all this stuff. They're going to run the borrower through stuff. They're going to use a title company. They're damn well going to get a lien on title and make sure there's equity to make sure that they get paid back. And so if you want to be banker and play banker, you don't just, wear the cheesy suit or whatever the bankers do and work banker hours. You do the documents. All right.
I like how Matt used WWJD and swore with damn it all in the same sentence. So that was very, very cool. Yeah. I mean, that's tapestry, words of tapestry. He's woven like
Yeah.
Christmas story. My father could weave a tapestry of swear words that was known in the Great Lakes region for it's hung over the lakes for years. Oh,
That's good
geez.
stuff.
Okay. I
All
get
right.
a point for quoting the first movie. Thank you.
That is point Kohler.
Point Kohler, Christmas story. Okay, there should be lots of documents. Okay, Matt, what do you mean by that?
Okay, in a PPM, is that what you're talking about? We're on to number 5 now.
Yep.
Number 5. Yeah. Okay, so when you have a PPM, there's going to be something called the offering memorandum or the private placement memorandum. That is PPM. Okay. This thing is 30 pages or plus usually. And it basically summarizes the background of who's raising the money, what's their business plan, what are they giving investors. It kind of lays out what the deal is. Now, another important piece that goes with that is what's called a Form D registration. You can go to sec.gov. If anyone gives you a private placement and tells you to invest, go to sec.gov, go to the Edgar search, that's what it's called, and you can type in the PPM and find it. Okay, that's a quick way to verify, did this person actually file the form with the SEC to do a PPM? And so you can do that yourself. That's pretty easy to do. I'll have the link in my article when I post it so you can find out where to go to that, but it is easy to find at sec.gov. And that's just an indication if this person's following the rules. Some people will just pull documents offline, try to do it themselves. They don't know what the heck they're doing. They're being cheap. They're not getting good advice. And let me tell you, those are the last funds you want your money invested into. The person that's trying to raise money, that's not talking to lawyers, that's not talking to professionals, that's not filing things in compliance with the law, that is the last person you want to invest your money with. That's how they run all of their business activities. Okay. And you're just giving them money to go, cause more chaos and how they do their, handle their business. So that's what I mean by documents. And one document check you can do is, again, sec.gov. Edgar search is what it's called, EDGAR. And you can type in the name of the offering and it should pop up. Now, I'll say this. If it doesn't, the only exception to that would be is they haven't received an investment, because you actually get 15 days from the day your first investor invests in the private placement to file that. So if it's brand new and no one's invested yet, it might not be up. But also that's an indication you may not want to be the first person investing because no one else has yet either.
Okay. Now, what I've been looking for is I actually wanted to read if you've watched this on YouTube, folks, and by the way, you can watch this on YouTube, catch this on Stitcher, iTunes, Spotify. But on YouTube, if you've seen me, I've been kind of looking down at my phone, scrolling, looking for a letter that came from a client. And I swear I took a picture of it because I wanted to always have it in my phone. And let me start with explaining the letter. And if I find it, great. But here's the background anyway. I was at a conference and I'd been speaking all day and talking about things like this and tax planning and being safe and asset protection. It's kind of more of an asset protection type presentation. So this woman came up after and said, and was kind of in tears, and she just handed me a piece of paper and walked away. And this is about 10 years ago. And I've kept that piece of paper and I took a picture of it so I could always share it if I was on the go. So I just put it in my pocket, and I got back to my hotel room and pulled it out, and it was just a page and a half handwritten. And essentially the letter said, and I'm going to paraphrase it, and unless I get lucky along the way here, she says, Mark, this information you shared today was bittersweet. About 3 years ago, a guy that we knew well, and she says, approached my husband and said, hey, I've got this investment. And he said, would you like to invest your retirement in this project? And I asked my husband, wasn't there a bunch of documents we should sign? And the guy that was pitching my husband said, what? You don't trust me? And then said under his breath, this is really odd. We normally don't have the wife in these sorts of deals. Oof. And this thing was just
wife. Oh my gosh.
Yeah.
Okay.
This guy, class A jerk. And she said, so we got home and I asked my husband, didn't he give you a bunch of documents to review, like when we bought a house or something? And the husband said, oh, I trust him. He's a good guy. And then I turned the page over for the last half of the story. And she goes, so as I listened to you talk today about asset protection, I'm glad that I've learned this for the future. But after a few months, we quit receiving payments. This man disappeared and claimed bankruptcy. And he basically and she goes, and it's sad to know now that he swindled us out of our $2 million retirement.
Oh.
Yeah. She goes, we went to talk to securities specialists and attorneys and the feds and the state to try to get our money back, but it's all gone. Please share this story with others. And every time I even paraphrase it, I get emotional. And so when Matt said on one of his number 5, you should expect to see a lot of documents, this woman immediately felt that. She's like, why isn't there a bunch of documents to sign? And there wasn't. And then she was pushed to the side. Don't you trust me? And the woman shouldn't be in this deal. Oh my gosh. And so it broke my heart. I've kept that letter and I've tried to share it whenever there's an appropriate time. So I think that sums it up.
Another great lesson there is trust your instincts too. When we have these instincts, and I think, I hit 40, this year, and I like to think to myself as old and wise now, but,
that's what I thought. Yeah. I looked at instinct. That guy's old and wise. I won't.
Yeah. If I'm going to be, my kids think I'm old, so I like to think I'm old and wise, but anyways, I just know as I've gotten older, let me just say it that way. There are instances where you do need to trust your instincts, and where I've regretted it and been like, I knew I should have trusted my instincts. I just didn't feel right on that one. And so like this lady in your example, I mean, her instincts were like, this isn't right. It doesn't feel right. And particularly for that sum of money. And so trust your instincts too. And this rolls into number 6, investigate the background of the person you're investing with. Okay. Again, go back to what would the bank do? If the bank's going to loan someone money, they're going to do a credit check. They're going to look into the background. Are you employed? Let me see a paycheck stub. Like they're going to go into this. Have you filed bankruptcy before? They're going to ask these questions and look into it. So, and also when you're looking into someone to invest with, trust your instincts too. Don't let them sell you on a pitch. One thing I think that's really important is when you're investing, the deal, whether it's a real estate deal or a new business or whatever it may be, the concept is important, but equally important, I think, is the person behind it. Okay. And because that person's controlling in the end, whether you get paid back or not. So investigate the background of the person you're investing with.
Okay. And I got number 15, and I'm going to save it as a
little teaser.
Yeah. A little teaser for the end here.
Okay. I like it. We'll get around 15. That'll be good.
Yep. And I put trust your instincts in this investigate persons. Okay, now I got a good story. Now, for some of you that are watching on YouTube, I'm not in the sexy studio today with the panel screen behind me and the little Dave Ramsey desk and all those goodies. I'm on location in Cedar City, Utah, and that's where our home office is. We started here 20 years ago. It's about 2 hours north of Vegas, Red Rock Mountains, kind of what you'd see in that Indiana Jones Last Crusade. Thank you. Point number 2. So
killing it.
Killing it. So,
You're killing me, Smalls. That's a point for me. All right.
Okay, fair enough. But I remember as I'm looking out the window right here, we had an office down the hill here, and I can see the rooftop of it. And I remember literally where I was sitting when this happened. So this is about 15 years ago when we were in our other building. And these clients, I think they were from Vegas. They had emailed over and faxed up. Remember fax machines? Kind of an exciting time in life. So they faxed over. I said they had loaned, it was a daughter and her mom had loaned someone close to 150 grand, somewhere in there. I knew it was, I remember it being over 100, but it wasn't over 200 grand. And I said, okay, give me the terms. What did you do? And she goes, I go, so they're not paying you? Nope. And I said, well, send me the documents that you signed. And there was silence. And I go, you have some signed documents, right? And she goes, yeah, but it's just one page. I'm like, okay. And they already knew they were in hot water, and I didn't want to demean them. They were already wounded. So I was trying to console them through it too. And I said, well, send over what you got. And they sent it over. And it was one of those fax machines, ripping it off the fax machine. Clear and present danger. Harrison Ford rips it off the fax machine. And I get an extra point for quoting a movie with Harrison Ford in both movies. Okay, so then I rip it off the fax machine, and I go, okay, and who are these people? And they go, well, we met them at an investment club. I was like, okay. Well, who are they? And they go, well, they're just in our club. And so I said, okay, well, I said, let me look into it. So I got off the phone. And the first thing I remember, and Deborah Stanton, one of my employees that's still with me today, I love her. I said, let's run this, Google. Google existed back then, people.
Oh, okay.
I said,
this was not Ask Jeeves or no.
I went to Ask Jeeves.
Ask Jeeves. Who is so-and-so?
Yeah. So I went over to the Commodore 64, pulled out the joystick, beep, 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 put their names in. And I go, put their names in. Not a good thing. One of the first things that came up was like this charge, investigation, within an hour, we had printed out several reports that they had been operating under close to 15 aliases. And I was sick to my stomach, and I knew their money was long gone. And these people were now getting chased down. A lot of times by the time you've lost your money, there's already an investigation going on. Like it just all unravels at once usually. And so we had to have that hard phone call and send it over back via fax and send them this, report of all these aliases. And it was just so sad. But it took us an hour. Just Googling their names. And you can go now online and pay $25 for a background check on people. And if someone's asking you for money and they're not willing to share their social security number or a tax ID number or their full name, their birth date, if they're not willing to share that, you got the wrong person anyway. So when Matt says investigate persons, you might be thinking, well, I can't hire Magnum PI. No, just get on the web, look to, get a report on on some sort of background check, and it can be very affordable. You can't call Jim Rockford. Dang,
Magnum PI.
That one. That's a little Rockford Files, baby.
Yeah. Remember that? I don't know Rockford Files. You've dropped that one before, and I've always been, I don't know that. I know Magnum PI because I'm a fan of short shorts. I've always rocked the short shorts. They're kind of getting popular now, but I've always rocked the short shorts,
Yeah,
like
it's
a
true.
7 inch,
Khaki short.
inseam. That it's
Yeah.
got to be like above the knee. Anything shorts below the knee, those are not shorts. Okay,
Yeah.
those are short pants. Those are not shorts.
Yeah. Matt's
Anyways,
calling those John Stocktons. They're called John
yeah,
Stocktons.
they're just size. Yeah, yeah,
Back in the 90s, everybody's going
greatest of all
long.
time.
Yeah, and John Stockton's still out there with his 8-inch cut and, feeding Malone
Yeah,
the passes and
I don't know if you noticed the NBA. A lot of players are wearing short shorts now. It's coming back,
oh,
especially the younger
hmm.
players. I'm telling you, trendsetter. Okay.
Okay, pressure no good. You got a
Seven.
story? I can tell this one. Okay,
I got it.
here's the
What's that?
principle. I'm going to tell. Here's the principle. Now
Okay,
it's your
got it.
turn.
Okay, go for it. Got it. Okay.
Okay. Okay. Here's the principle. If someone says you got to move now, you got to hurry. We're going to lose the deal. Send the money over. We'll do the documents later. If there's any pressure at all, it doesn't mean you don't do the deal. Just back up. The hair should go up on the back of your neck, and you go, all right, maybe there's some pressure. I get it. But let me investigate a little more carefully. And then the second point I'd make is I will make you a promise on this podcast right now. Matt hates it when I make promises, but I'm going to make this promise and I will stand by it.
All right.
There will be another deal next month. There'll be another deal, people. And the one deal that you're going to miss, trust me. Now, this doesn't mean you can go into analysis paralysis and never pull the trigger. But if you're feeling pressure from someone, you got to be able to say, you know what, there'll be another deal. It's not, this guy didn't come up with sliced bread. I'll be okay. Story, example, anything?
Yeah, this is actually a positive one. I'll keep, we're always giving like the negative here, but I'll give a positive one. So we had a client that was wanting to loan money, kind of like a hard money loan on a real estate deal that was basically in crisis. Okay, there was a first position note that was wanting to basically foreclose. There was plenty of equity in the property, and but the investor owner thought they had a buyer. They weren't stressed about getting more money in time. The sale fell through for whatever reason. I don't know. But my client comes in to basically save the day. Now, they were under significant pressure. They had like 48 hours to get this thing funded. And so you had a time crunch. Now, what did that client do? They devoted the next 2 days entirely to doing all the due diligence, making sure everything was done right, getting the documents done, getting title involved, getting everything recorded, and really jumping through all the hoops. Okay. And in many ways, that's sometimes how you can find some opportunity, particularly in like the private lending space and stuff like this, where there's people are willing to pay higher rates and points for short-term loans. But you only do that when you can adequately jump through all the hoops. And if you're smart, now this client was well known in their space as a private money lender and someone that could do a deal fast because they knew how to analyze it fast. They had the team, they had the docs, they had the closing system, they knew how to check title fast. You know what I mean? And so, so that was one that it's like, we saw it turned around within 48 hours, and I probably seen some faster than that. So it can be done, but don't think, well, I better, if you don't have the time to review it and understand it yourself, get professionals involved for the pieces you don't know, engage title if that's applicable, if there's supposed to be a lien, you're loaning on real estate, for example, to check the background of the person. If you don't have time to do that type of stuff that we're talking about here, then don't invest. But sometimes you actually can if you focus. Bear down, as they say in Arizona. That's an Arizona thing, bear down. And get your crap done.
Yeah, and you know what they're going to do in that 48 hours is the list we're talking about.
Yeah.
Do, and I'm going to add a rider to Matt's little example, if I may. A short one is that Matt, I like what he said. If you don't have the time to get this due diligence done in that period, don't do it. And then Matt alluded to this, and I'm going to say, if you don't have the skills, you may have time, but you don't have the skills or resources in that short time. And this draws me back to the year in high school when I was a junior and played on the high school varsity team. I played on the
was this?
Basketball.
Basketball. Okay. You left that out. Okay.
So I'm from high school basketball
I'm
varsity team as a junior. Now, some of you may
okay.
go, "Wow, Mark, I'm tall, I'm 6'2". Some of you are like, "Wow, you must have been really good." No, I was from a small high school, and the rest of the team was finishing up the football season. Because they'd gone to state in football, and my graduating class was 62 people in this farm town in Washington State. So the same guys that were the starters in the football team were the same starters in the basketball team, and then they were the stars of the baseball team. That's how it kind of works. When you
Mhm.
only have 30 guys to play with, half of them are nerds, and the other half they're the star players.
Yeah.
I'll let you figure out which group I
This
was
makes
in.
more sense. This makes more sense. Keep going.
It's come together for you. Okay, so so the whole school is traveling to go watch the football players play in state. And the basketball coach was like, damn, we got our first game tonight. There's no fans. They're all gone. And I've only got my scrubs. Hence, I got to start. See, I can always say I started in
Okay.
basketball as a junior for this one game. And but it got down to the game down to the wire of this game. And it was like, it was a buzzer beater moment. It's like the movie Hoosiers, point for me. And my coach was like, you get in this huddle. And if you've ever been there, the coach is really in a perplexed moment because they has to choose who's going to take the shot. And we got 3 seconds to get down the court and take the shot. So there's pressure.
And you guys are down. You guys are down. You got to make this to win or tie or whatever.
Yeah, that's right. We got to get down the court in 3 to 4 seconds, take a shot. And this is kind of like the deal, pressure's okay. You got to have time to do the due diligence, or you got to have the skills in that time period.
Okay.
So the coach, I remember this fateful moment in my life. I've gone through a lot of therapy, so I can talk about it now. The coach looks around at the 5 of us, he looks at me. It wasn't that look you want, but the look like, I've got faith in you look. That was not, it was kind of like, if you want to win this one, don't give it to Kohler, And so
I thought he was going to be like, I'm going to play a wild card here. Let's give it to Kohler. Why the hell not?
That would have been more than a wild card. This guy's like, my career's riding on this. I got to have a winning season, and
he's like, I'm going to be coaching like the badminton team if I don't win this game. I gotta win here.
That's right. If we were down to the wire on the badminton team, I might have gotten the call. But this is varsity basketball, which in a small town is a big deal too. It just happened everybody was tailgating across the state. So he looked at me, and I didn't have the skills, so we gave it to someone else. I really don't remember if we won or lost. I just remember that look. You
just remember being passed over and being like, you don't got it, kid. You don't got it. Well, you know what? Just at least you made the team. Michael Jordan didn't even make the team his first time, right? So, you made the team. It's all right.
There you go. So, therapist said, Mark, when you talk about this, it means you're healed. So we had a breakthrough in today's session.
I have not heard that story yet. This is a new level of intimacy.
Well, I'm going to share it with you and the thousands of listeners.
Yeah.
Yeah.
Okay. Well, now
whose
some
turn
people got the skills. Some people got the skills. So, and I'll say this: if you're a new investor, this list is more important. If you're a seasoned investor, some of these tips like, "Ooh, I should be thinking about that," and I've been burnt on that. And I'll say this too: you're going to lose on some deals. You're going to get burnt on some stuff. Okay. Not every non-traditional investment is going to work. And I got a little summation here, like summary at the end I want to give, but
save it. We got to hurry.
Just keep that in mind. All right.
Okay. Now
ready
it's
for 9. Okay. I got 8. Okay. We're on 8. We got to move. Okay.
So it's my turn. 8. I'm going to summarize it and then use story.
Okay.
Make sure your lawyer is representing you. So I think that's pretty self-explanatory, but it's common on smaller deals. I think it's common, and we do this at our firm. Partners come to us and say, we don't want to hire 4 different lawyers. We got 4 partners here. Can you represent the entity? And our legal team knows to pass around what's called a conflict waiver. And everybody says, yeah, I like Kevin, Jerem, Lee, Christy, Darren, the team, Devin. They're like, yeah, I'll use one of your lawyers to represent the whole of us.
Yeah.
And that can be acceptable. But we want to make sure our clients at least understand that that's what's happening, because you want to make sure your lawyer you got to make sure whose side of the table they're on. So I don't know, any
Right.
story or example, Matt, to
Yeah,
bring
yeah.
that
I
to
mean,
life.
I've had that one many times. I get a client will send me documents and they'll say, "Well, their lawyer reviewed it for us." For us? Are you sure that lawyer wrote that for you? 'Cause that's
Their
kinda like
lawyer?
that's kinda like your spouse, you're in divorce court and you're like, "Well, I got a lawyer for us. Don't worry. Our lawyer's here." "Oh, our lawyer? Really? Okay." So, so you'll wanna engage your own attorney, and like Mark said, if it's the partnership situation, you might have a lawyer representing the group and kinda trying to draft the kinda normal terms between the partners, but you should still look at, do I need my own counsel? And should I get my own advice for my specific situation? If you're doing 6 figures or more on an investment in particular, get your own lawyer. Have your own lawyer look at it. Even if our firm drafted it, get your own lawyer to look into it for your interest and advocate for you and what you need in the deal.
Yeah. Oh my gosh. Ooh, that brings me back. That's number 8. And Matt, you're going to explain number 9, seek opinions of others. But I want to
Yep.
go back to number 1. Just one quick side note, and there's stories of this with Arnold Schwarzenegger. It's a longer story. I'm just going to truncate it. When he was a brand new actor, he got taken advantage of in one of his first deals. And there was a language barrier coming from Austria to the US and this and that. And he tells the story of, I was never going to sign anything again unless I understood the document. Now, Matt said earlier in number 1, understand the deal. And so I want
Yeah.
to kind of amend that one to say, understand the deal and what you're signing. Those are 2
Yeah.
different things.
Yeah.
Yeah, which brings Matt's famous quote, a good deal,
Yeah.
turd, whatever. Go ahead.
Yeah. Yeah, if you have a bad contract, you have a bad deal. Just like Arnold saw, if what was in the document at the end of the day isn't what he thought he was getting, that deal sucks. And we've seen this. We see people like, Arnold may have been able to make money in his deal or whatever it was, and it was a good deal, but the contract sucked.
Yeah. What did you say before?
If you have a bad contract, you have a bad deal.
Yeah. A good deal a good deal can turn bad with a bad contract. I've heard you say it that
Yeah.
way too.
Yeah, that way
And a
too.
lot
Yeah.
of people, yeah, and a lot of people put on their blinders. They say,
Yeah.
this is such a good deal. And I believe you. It's a good deal.
Yeah.
I get it. But your contract sucks.
Yeah, it
And so
sucks for you. It's a good deal in general, just your piece of it actually sucks, as Arnold
yeah,
found
yeah.
out.
So understanding the deal. And I think a lot of times when you say the lawyer represents you, this is the last point I'm going to make on that. The lawyer is not there to protect you entirely. A lot of times people say, well, I have my lawyer look at it, and then they want to sue the lawyer because the deal went bad. Really, what we've been trying to teach our associates for years is the lawyer's job is to help interpret the document, to help explain what you're getting into. We're not going to
Yeah,
rubber stamp the deal. We're going to say that this document says this. Is that what you wanted? And so
yeah,
we're there as kind of an interpreter. And so when you meet with your lawyer, it's not for that. In fact, I had this last week, Matt. I had a really volatile phone call with some people. And because the client got on and said, Mark, I want you to tell me if the document is going to protect me. And I go, well, what do you want? Well, I want this success in this deal. Well, I can't guarantee success in the deal, but I can tell you what the document tells you. And he didn't like that. And so
yeah.
also people were selling and were jerks and it didn't go well. But okay, your top number 9,
All
seek
right.
opinions of
Yeah, seek opinion of others. I think this could be other investors, business owners, people whose judgment you respect. A lot of times, particularly if you get hyped up on something, some investment, talking it through with someone can expose some things you
Mm,
might otherwise notice. And I think we've all been down that road, whether it's something we've gotten into, whether it's, I don't care what it is. It could be anything that you get excited about, but then you explain it to someone else, someone whose judgment you trust or a close friend, partner, whatever it may be. And they're like, What about this? What about that? And you can start to reflect back. So before you invest, I always like seek out some opinions from other investors. It's not like it's just the lawyer that will help you, or maybe you engage your CPA if there's some tax issues. Okay. It's also just from a global, just like business. Is this a good idea? Maybe it's real estate. You want a real estate professional's opinion on it. Like seek out those people's opinions, talk through it. I think it helps expose the weaknesses in the deal and the things you might be missing.
I love it. Okay, now I'm gonna, instead of maybe a specific story, I want to give two, uh, expand on that with 2 points. One is, it's not so much that I may want the opinion of Matt. Like I may say, I've got this deal and I want Matt's opinion. It's that one of the major benefits is that I have to explain it to Matt.
Yeah.
And as you're saying it, we've all, and you alluded to this.
We do it
As
all
you're,
the time between us. I mean, you and I will
yeah,
argue over something, and it's like you'll explain, and then we're kind of like, yeah.
yeah.
I came in so confident on that point, but now that you say that,
Have you ever had that with your friend? Like Matt will sit there and I'll explain the deal and I'll go, yeah, you're right, it sucks. And you go, I didn't say anything. Yeah, I know it sucks because you verbalized it, you know? Um,
yeah,
okay, Ocean's 11, you know, when he's at the bar and he's like, and you know, Brad Pitt would be like, yeah, we really need an 11th guy. And, or no, maybe it was Daniel Ocean, played by George Clooney, is explaining it. And he looks at Brad Pitt and Brad Pitt doesn't say anything. And he's like, yeah, you're right. We need another guy. And so it's kind of when you verbalize it, you already know the answer.
yeah, yeah,
The second thing I was going to say, seeking opinion of others. And I hate to play marriage counselor here, but I'm going to. And maybe you're not married, but you have a significant other. If you're going to do a deal, talk about it with your significant other. I don't care if you're the male or the female, the spender, the saver, whatever role you play in your relationship. I've seen so many marriages go down the toilet because they went and did the deal without talking about it with the most important other, and that's
yeah,
your spouse. Make sure you're talking about it. And sometimes you know they're going to say no. Maybe there's a reason why they're going to say no. And if your spouse says no to everything, maybe you've got a bigger issue you need to deal with before you go do an investment.
yeah.
But you got to be on the same page.
That was so wise. All right.
Woo, thank you.
Okay, my number 10, I want to save for last. You got your last one, but let's hit yours if you don't mind, because it ties into
Yeah,
my
okay.
final.
We'll put the comfortable one at 15. Okay.
Yeah.
Okay. Let's go over to number 10. Don't put
Yeah.
all your eggs in one basket. I've got a story to go with that. So I don't know, Matt, do you want to explain it or should I just go with it, or don't put all your eggs in one basket?
Go for it. I'll give an example on 12.
Okay. So number 10, don't put all your eggs in one basket. I was meeting with, I'll just use Brian, one other example, this friend, family member. I didn't know he's listened to the show because I always got to. And he was telling me about this investment. And I said, okay, yeah, that's cool. It could work. But let's not put your entire retirement in that. You know, he was self-directing, had about, you know, I'm not going to say what dollar figure. But he was thinking of really putting the bulk of his retirement in this self-directed format into an investment. And I said, even if it's a good deal, you don't want to put all your eggs in that one basket. And right when I said it, we both looked at each other and we said, yep. And it rung true. And like Matt said, it's got to feel good inside. And he was like, done. And maybe he'll throw X dollars at it. And whether you have 100 grand and you're going to put 25 into something, or you have $1 million and you're going to put 250 grand into something, you could allocate 25% to something and try it out, but don't put all your eggs in one basket. So
Yeah, that's such good advice. And I think right now with all the things we've seen this last month with crypto and GameStop stock and AMC and all these things that have just been like crazy up and down. That's such wise advice. And, you know, the advisors would call it diversification, right? That's what they're going to call it and make it sound all fancy. But I always like of Google, you know, the company Google and how they manage their money, like they're reinvesting in their own technology and what they know. But they have these things, and I think a lot of the tech companies do this too. They have kind of these like moonshot ideas where they're like, "Ooh, we're gonna put a little side of our budget over here for this like moonshot idea that like if it hits, it's big. This is gonna be a breakthrough technology, but we might know it's never gonna hit, and it's just gonna be a zero." And so, but they budget for that, and they think about that, and they're careful managing those expectations. I think the same is for your investments. If it is a more risky thing, like let's say GameStop stock right now, or cryptocurrency, for example, um, these are things that are kind of like moonshot type things, and so don't go all in on it, but just take a measured approach. Because if it does hit like you think it is, let's say crypto in 10 years is what you follow the pundits who are big crypto fans, like 10% of your portfolio or 5% or even 1%, that could be a pretty huge return. You don't need to go all in. I think some clients like, if I put all my money in, I can make $100 million. Why don't you just put 10% in and make 10, or 1% in and make 1? Because that way you don't lose everything if you're wrong. I don't know.
I love it. I thought you were going to talk about the moonshine idea, and a little goes a long way. Usually, you're looking at 180 proof. Yeah, it's like Everclear. We all in high school. I think most people that ever dabbled in alcohol or something, they had that one experience with Everclear, which is kind of the branded label of moonshine.
Yeah,
it's not a good experience. Yeah, you want to.
Yeah, luckily I steered clear of that. I do shout out to Everclear, the 90s band. The 90s band Everclear, pretty great.
Yeah, they are. They're good.
They're great.
Okay. You said you had a good example. Was it the difference between lender, partner, investor, or watch out for affinity fraud?
Ooh, I could do one on either, but
okay, I'll explain.
Explain lender, partner, investor.
Okay, I'll explain that, and then maybe you got a good example. And I know this show is longer than usual, everybody, but it's that important. We're probably over our limit, but you know what? That's okay. We're here to give.
Yeah.
We're
almost there. We're almost there. You're almost there.
You're almost there. These are so good. You probably listen to the podcast over 2 or 3 drives. That's okay.
I want to get on to something else. What happened in the Super Bowl?
If Matt would quit telling dumb stories and jokes, so we'd be through it. I know it bothers you. Okay, so number 11.
Guilty as charged.
Know the difference between lenders, partners, and investors. Now, I have a whole video of this in my little tax and legal library at markjkohler.com. This is in one of the chapters of my books too. I know Matt talks about it, but let me just in summary, you can't be all 3 of them. In fact, I argue many times you can't be 2 of them. You're either a lender, you're a partner, or you're an investor. And in summary, quickly, a lender loans money, gets a fixed rate of return, interest, points, there's a term, there's security, yada, yada. A partner is a voter. It's a democracy. You get to play with 2 or 3 people, maybe 5 or 6 at the most. You're having regular meetings. There's complete disclosure. You're making decisions. And even if you have a small vote, you have a vote. And if several of you partners get together and vote as a block, you can take out the main dude. Say, you know what? You're not doing your job. So and the main dude has got to know that. So this is a partnership, typically an LLC. You're all involved from the beginning. You get a big piece of the upside and you get a big piece of downside. It's a partnership. An investor, the best way I like to describe this, is a silent partner. If you're a silent partner, you're an investor. And when I have people come to me and go, hey, I'm going to raise money with a bunch of people, and I get to call the shots. Oh, so you want silent partners? Oh, yeah, I want silent partners. That's an investor. And so that means you're going to have a new friend called the SEC, and you're going to have to file documents and make sure the SEC is cool with this, because they don't want you to have silent partners unless you disclose all the plans you have, and you can't make big promises. Well, I want to make big promises, or people won't invest with me. Now we're to the heart of the issue. So investors are silent partners. They put in money. They may make more than their interest rate, but you're not going to get a big piece of the upside or a big piece of the downside because you're an investor. You can lose your money, but anyway, so know the difference between those. So when someone pitches you, the thing in your head should be going, okay, where do they want me? They want me as you want to be figuring out where they're going to categorize you. They're going to use lots of flowery language. They're going to wine and dine you on the golf course or out for a steak dinner. But in the end, you're one of those three.
Yeah. One that I see a common problem here is people who are raising money. And so let's say you're on the investor side looking to invest, and there's like 20 or 30 people going in on this. And they just have a regular LLC operating agreement. They tell you you've got voting rights. They don't do any of the SEC stuff for a PPM. There's no offering document or offering memorandum. They did not file anything, a Form D with the SEC. And they're basically, it's like a partnership that's gone overboard. They've gone too far. They've taken it too far. And
you've seen the guy at the gym that went too far with the steroids.
That's right. That's right. They went too far. All right. And so, so those are the ones where I think that's probably the biggest mistake. And I have to say, those seem to be the deals that fail the most.
Yeah,
they are.
I say
Because the deal is not sophisticated. They're being cheap. They're being lazy. But they're willing to take money from lots of people and aggregate you all into a group. So, so that's probably the one I would really watch out for the most. The lender is straightforward, right? You're playing the banker like we talked about. You're getting a loan. You're securing it on title in some way. The partnership, you got voting rights. It's a small group, like Mark said. The investor and kind of this is the one where you got to be a little more wary. Make sure you're getting the right docs, as we talked about.
Yeah, gosh, I set you up for such a sweet little stand-up rant.
The steroid one?
Oh yeah, you're saying too many partners in a partnership is just too many steroids on that guy at the gym. You went a little too far, or the woman that's like a little Botox. Okay.
Yeah. Okay.
Yeah. Matt goes around in Scottsdale, Arizona. He sees a little too much Botox once in a while, right? Come on.
Yeah, no? There's a little Botox. Now, I will say I'm going to get some Botox because look at this forehead. Even on the video, look at the lines on my forehead.
Yeah, not good. Which brings up a story that goes down in Kohler lore that's not enough time for this show. I got a little Botox before my LA box.
This was terrible. This is the worst.
Terrible. Yeah. Look up angry eyes. Just
Botox. Mark's eyes were like this. I was like,
the lady at Fox was scared. She's like, get this guy off the stage, get him off the set. Yeah.
Botox. But see, that's the difference. In Scottsdale, the Botox you get here, they know what they're doing. All right. In Idaho, the Botox you get up there, they're still figuring it out.
Touche. All right. Number 12. Oh my gosh. But this is so good. Number 12, watch out for affinity fraud. We had an SEC investigator that had retired out of DC and had written a book on fraud. So smart, so well-spoken. We got to have the guy back. It was like 3 or 4 years ago. And when we interviewed him, I was really excited to ask him, what's the number one type of fraud out there?
Yeah.
See, 100 years ago, it was you got held up behind the building with a knife or a gun, that
robbery.
That was robbery. Now it's this, type of paper, white collar crime type fraud where your identity's stolen or people take your money and make you promises. And so he said the number one fraud is affinity fraud. And I was like, what's that? And he educated us on it's the person in your church. It's the person in your family. It's the person in your neighborhood. The person at the office around the water cooler. There's a lot of wolves in sheep's clothing.
Okay, I'll tell you who it is. It's Uncle Roman from The Great Outdoors. The Great Outdoors, Uncle Roman, Dan Aykroyd,
Yep.
Yeah, with John Candy, Dan Aykroyd. And Uncle Roman is trying to swindle his brother-in-law, Chet Foley. I think it's his name, Chet Foley, who was John Candy. And he's trying to he's pumped him up on this fraud that he's got some great new stock to invest in. And Uncle Roman's a successful stockbroker and all this. And the classic line of that, though, is anyways, that's a good example of affinity fraud is Chet Foley, Uncle Roman. Okay. Don't invest with an Uncle Roman. Avoid Uncle Romans.
Okay, number 13. Good example, Matt. I lost track of who's got more points with some good movie quotes. I've been
I
trying to
know
get.
that was a 3-pointer, I think. I think that was a
Yeah,
3-pointer.
well, we'll see. We
This
should
was a fraud. It was fraud too. That
see.
is affinity fraud.
ESPN has it down with the in the zone or whatever they call it, and there's the
Oh,
four
yeah,
windows,
on
and
the
they
points.
yeah, and they're in the booth going ding, ding, ding. We need that person. We're too
Yeah.
cheap. We don't have that. Okay, now the next number 13 was know your terms, and I apologize, Matt, you may have not liked this, adding it to the list, but I think it's an important one because this goes back to being educated and being the dumb money at the table. If someone throws out the word accredited investor, PPM, note, security agreement, Reg D, SEC. I mean, we could make a little test here of about 20 terms, and you better know darn well 18 out of 20, because if you don't know the terms, you're already should stop, drop and roll. Just stop, drop, hit the ground, roll. You're in a fire. You're in a fire zone. You're gonna get
Yeah.
smoke inhalation. Stop, get out of there. Spend some time reading some good books, listen to some good podcasts. There's always going to be another deal. Oh my
Yeah.
God. Don't rush.
Yeah.
I'm not going to take time to define that. Accredited investor is a term that basically means you know what you're doing, and you should know what that definition is. And anyway,
Yeah. Yeah. It's basically if you have a $1 million net worth and you don't get to include the equity in your home, 200,000 income if you're single, 300,000 income if you're married, that either one, you make a lot of money or you have enough assets. The SEC is like, you're accredited. You obviously smart enough to accumulate that money or to have that type of income. We'll let you invest in some of these types of non-traditional, quote unquote, alternative investments.
yeah, and I didn't. This is a good point because I had a client this week that said, "Yeah, I've got to sign off that I'm an accredited investor. I make at least 250 grand a year, or have $1 million in equity, not including your home." And he was relying on his W-2 that was close to 250. I mean, sometimes if you have to shoehorn yourself into that definition, there's a reason why they have that line drawn in the sand. They're trying to protect you. So if you're trying to figure out how to qualify as an accredited investor, maybe you shouldn't be doing deals that require you to be an accredited investor. Yeah, do some other things.
Yeah.
Okay.
Um,
Ooh,
okay.
14.
Uh,
And then you wrap up 15. So here's 14, which kind of goes along with 13. My 14, which was my grand finale, was turnkey investments aren't always what they're cracked up to be. Now, what I mean by that is kind of like this accredited investor thing. This client really wanted to do this investment. He wanted to be defined as an accredited investor. He was kind of shoehorning himself into it, and I think sometimes controlling your own investment and not jumping into the security deal, not jumping into the PPM is okay. Go knock yourself out on a little fixer upper or a little fix and flip. And you may say, I don't know how to do a fixer upper. Well, you sure as hell don't know how to pick a PPM or, PPM. So at least you control the deal. Sometimes being number 38 out of 122 investors isn't the best deal for you. And so it does. Sometimes we think the grass is always greener. And so just because you want to do a security deal and these guys are making millions, you might be better off buying a little rental and putting your grandkids in it, or buying a little rental and putting your college kid in it, and getting a 10-20% rate of return there that you control your own destiny and your exit. Buying into a PPM doesn't mean you can always get out when you want to.
yeah.
So I don't know. That's my take there. Any advice, Matt, you'd agree?
Yeah, no, great. I think one of the biggest lessons I've seen just is in working with successful clients that have big self-directed accounts is um, great investments aren't sold, they're found. Okay. And
Mm,
yeah, and so
mhm.
when I see clients make a really good deal, they find that deal. They go out and source it, they negotiate it, they make the deal. Now, those clients also will make deals. They find a deal like that to bring other people in, but they're not going to get the same deal the person that found it is. You know what I mean? They're going to cut them in at a different rate of return or a different variety. And I just did one last week of a client that's going to make about it's a $2 million real estate deal. It's going to make about $400,000 on it within a month or two, and brought in some other people that are going to make, tens of thousands of dollars for putting some money in to help pull the deal off in a short period of time. But that deal was found. Okay. And so now deals can be sold. I have some clients with really big accounts that are in PPMs that have had great returns, but it's, you just don't know. But that one principle I think is important.
Ooh, and I've
Great
got a
deals are
quote.
found, not sold.
Say it one more time because I cut you off.
Yeah, great deals and great investments are found, not sold.
Okay. And these are, of course, general rules that there's always an exception. And I've got a good quote that I'm going to throw out when you talk about number 15. Number 15.
All right, number 15. This is my final one, and I'll give my little speech on it, and then I'll let you close us out, Mark. Is that cool?
Okay. All right.
All right, this is my last one. Be comfortable saying no. I think a lot of people get into something, they meet somebody, maybe it's the investment club Mark mentioned, or it's the family friend or the neighbor, and they get enough down the conversation, they feel like they can't say no. They've talked about it too much. They promised this person has some expectation on their side, and they just, for whatever reason, people just get a little too committed. They get a little bought in themselves too much emotionally. You've got to be comfortable saying no and taking the emotion out of it. And what I want to say at the end here is, don't be scared about non-traditional investments. I don't want people to hear about due diligence and think, well, this just means I should just invest in a mutual fund and just, do nothing. Okay. No, I'm not saying that, but know what you're doing. There's a lot of non-traditional investments, a rental property that you own or your self-directed retirement account owns, that's very low risk, compared to buying cryptocurrency, which could be very high risk, or maybe something in the middle, a private placement that could have big returns, but also is a little unregistered and you don't know, so just be measured in that. But I'll say this, you've got to get out of your comfort zone, ask a lot of questions, demand additional documents, and be cool saying no. And just remember that the best person to protect yourself is you. So do it.
Okay. Woo. All right. And dude, your summary plays right into my quote that I was going to give.
Okay. Shake and bake. All right.
Okay. Shake and bake, baby. Ooh, Talladega Nights.
Slingshot.
Okay. You're slingshotting me up there. All right. It's easy to say, be comfortable saying no, but how do you do it? You need sometimes an excuse. So one that is easy that I would love many of you to use is say, I promised Mark or Matt I'd have them look at it before I go forward, and I've entrusted them. And if they make us the bad guys, if they say no, it just doesn't fit my overall plan right now, I need to rely on those guys. So you can always make the law firm here or accounting firm the bad guy. So that might give you a way out. But here's the one I love. Stay in your lane. And what I mean by that is you have some expertise. You might be great in the engineering space, and you might be good in the pharmaceutical space. You might be great in the real estate space. You've spent your whole career, your whole life being good at some type of industry. Those are the type of PPMs you want to look for because you're going to be better at it. And you can look for non-traditional investments. I love it. If you're good in pharmaceuticals, you're going to look for a startup or a PPM or a small project where you know the industry a little bit. You know the insiders, you know the play. Now, if you want to go buy a mutual fund in pharmaceuticals, fine. But look for a non-traditional investment in your lane. Stay in your lane. If you're good as an engineer, maybe going and doing a real estate PPM is not the best move. Go do it. Do a PPM that you kind of know about, your industry. And take action. Don't get in analysis paralysis. And it's okay to tell someone, it's just not in my lane. It's a great deal. I appreciate it, bro, but it's not for me.
Yeah, you can even one other one I like to use. I found I had another deal that I went in on. Something else is more clear cut and straightforward and a better deal. And sometimes that brings that person back that wanted to do deal with you to be like, well, let me see how I can sweeten it. Because if you really did like that deal and you wanted more time, sometimes that's another one. Is just like I ended up going in on another deal, but hit me back up later if you got something else.
Yeah.
I like using that one, and I've seen clients use that. One of my biggest clients used that on a deal for like a hotel. Okay, this is last story, but he basically turned him down. And I was involved in the conversation, some of the negotiations, and this was millions of dollars. He was the big funder. It's basically going to blow their deal, and he basically turned him down. And what happened? A few months later, they came back with a way better deal for him. They said, all right, I'll do it under these terms. And so, but he got in control. That's the thing. You don't realize as an investor holding the money, the control you have. You have a lot of power with it. So you should use that to your advantage.
Oh, and gosh, this is such a great podcast. I'm going to go out on a limb and say that. And I want to, a good show to watch to give you the good cojones and ammo for this stuff? Watch Shark Tank. Watch it. Just over and over again. And it's funny, sometimes, Cuban will give a offer and then there's so many different players there. I'm going to screw it up. But another Branson is on there now on occasion. And Branson, just to piss off Cuban, will go, I'll give you a better deal, And the person presenting just holds out. Sometimes they hold out long enough that someone else throws out a better deal. And if you're not good at playing poker, involve someone in the negotiations that is. I'll tell you right now, Matt Sorensen is my partner for a reason. He is so good at this. I'm a little more dramatic. Some of you may have noticed. Mr. Sorensen, he's a smart cookie. And so have a partner like that. And this is why it's always good to, once they give you the offer, step back. Well, go share it with those other people. Go have your lawyer review it. No one's going to expect you to say yes the minute they lay it out on the kitchen table. Take your time. And there's nothing wrong with that. But and on that final note of diversity, just because someone says be diverse, it doesn't mean you're going to invest in real estate, some sort of nutrition supplement, an auto dealership. You can diversify in your lane, in your freeway. You can find revenue. It's still in an industry, at least you're familiar with. In non-traditional investments, even more so. So when we say diversify, it doesn't mean you got to be an expert in 4 different industries. I don't want you to start doing import export from Asia because you need to diversify. If you don't know anything about that, don't do it.
Yeah. So. Yeah. I believe he's an importer exporter. He's an importer exporter.
Bambly industry. Have you heard of that?
Yeah. What type of business is in? Okay. Well,
you take us out, baby. Take us out, man. I got a show.
Thanks, everyone, for listening to this special co-production of the Main Street Business Podcast and Directed IRA Podcast. You can go to mainstreetbusiness.com for Main Street Business Podcast, directedira.com/podcast for Directed IRA Podcast. And then check out for my newsletter article, which will be in our newsletter, which you can get at mainstreetbusiness.com and at directedira.com. That'll outline this top 15 list. I'm going to add all these items. Mark and I added in here at the end too. And thanks for hanging in there with us on this. Hopefully it was helpful. Maybe it'll save you $1 or $2 in the future.
Thanks, everybody.